Good afternoon. My name is Rosha Washington, and today I'm going to be doing my project on forecasting one-year interest rates and the yield curve. It's for Finance 401, Dr. Danielle Lewis's class, and the week I did my time span on was November 12th, 2013 through November 15th, 2013. I'm going to start off talking about the interest rate forecast over the years. I forecasted all the way out to the year that I came, which is the year of 2028. The flattening of the yield curve means good forecasting on one-year interest rates using the expectation hypothesis. With interest rates increasing, less people are going to want to buy homes and put money into the market. So the Feds will probably have to step up again and offset the market like they're doing right now with Fannie and Freddie Mac. Tuesday to Friday. Now let me tell you why I did mine on Tuesday. I skipped the Monday. Monday was Veterans Day holiday, so all of the markets were down. So I had to go to the previous Friday of the last week and then to Tuesday. So that's what I'm going to compare from now. With the Feds pulling out of the race, not buying into the bond markets, it is expected that the interest rates to rise, considering the market should be back on its feet. And on Friday, November 8, 2013, which was the previous Friday, after a recent unexpected dry boost in October, the U.S. stock index futures turned sharply lower, raising the chance that the Feds will stop stimulating the economy by the end of the year. And now I'm going to go into the year curves for the week. From Tuesday to Wednesday, the Dow and the S&P 500 declined on Tuesday after rising bond yields increased debate over how soon the Feds will start trimming its stimulus package program. Overnight trading volume was heavier than usual after the U.S. bond market was closed on Monday for the Veterans Day holiday. About $50 billion of treasuries changed in hand in the cash market as of 8 a.m. That was about 34% above the 20-day average, according to the ICAP, the biggest interdealer broker in the U.S. government day. And I'm going to go to Wednesday to Thursday. And over these days, the yield curve wasn't really doing really much. It was steepening to some levels, but on Wednesday, this is when it turned back up, Wednesday to Thursday. Stock indexes fell on Wednesday as uncertainty over how soon the Federal Reserve will begin to scale its stimulus efforts curbed investors' appetites for risky assets. Also in recent news, the U.S. Treasury price will be held steadily at high levels due to the slow improvement in the job market and an increase in the U.S. balance with other countries, which will require more assistance from the Feds and the government. So again, the Feds have a lot to do with this yield curve this week with a lot of the news articles coming up. But it didn't have really much change during that day. Now, from Thursday to Friday, Janet Yellen was nominated to lead the Federal Reserve, bolster expectations to the central bank, which maintains its economic stimulus package for being there. Now, everybody knows that Janet Yellen is more so of a dove in the financial industry, so people were kind of concerned with her being in the lead for that position. Also, the 30-year bond market didn't perform like everyone wanted to at the poor debt auction early Thursday afternoon, which in result will cause the yield curve to steepen just a little bit on Thursday, Friday after the closing times. And let's just see what we said for that. And now this is the overall thing from last Friday to this Friday, from the previous Friday to the Friday that I did my forecasting on. As expected, the yield curve did steepen from Thursday to Friday. However, it was only by a small margin. Overnight trading volume was higher than usual after the U.S. bond market was closed on Monday for Veterans Day. With the central bank still buying into the bond markets and stimulating the economy, the yield from now has flattened just a little to keep interest rates down over the past week. As expected, the yield curve did steepen for Friday, but it was only by a small margin. The S&P index climbed 7.56 points or over the day. And that's the end. But in conclusion, based on a series of events that happened over the week, I predict that the yield curve will continue to steepen, causing interest rates to fall in the near future.